Now let's take the conversation forward. Mantesh, some would argue that today's price action in banks is also a function of what we heard from RBI on Friday.
Yes, in a way you're right. There is caution in the air as far as the banking space is concerned. But nevertheless, one should mention here that the first quarter result of most banks have been a positive surprise simply because of two things. One, the moratorium given by the RBI has not been used to the fullest extent by the bank customers. So that tells you there is a great deal of cash liquidity available with many of the clients of the banks. That's number one. Number two, even in this situation of low GDP growth, low growth environment, the banks are able to push through credit and are able to post profits, thereby upping their net worth. So I guess these 2 points are more important. But yes, you are right. The caution by the RBI is in the air, and that's why the bank stocks have corrected.
So would you take the RBI stance seriously, because the regulator rarely comes out and talks about the liquidity or the balance sheet or the NPA concerns? I mean, the regulator does not like to comment on the problems, and especially in this kind of an environment, if RBI is raising a red flag, do you think analysts and fund managers and investors should not take it lightly?
They should. Incidentally, to the extent of what caution has been factored in the stock prices is what is more important from the analyst point of view or the stock market's point of view. So every news, as you're aware, gets discounted. Every outlook, every fundamental outlook gets priced in much before that outlook actually takes shape. So I would reckon that the stock prices, when they correct or they have been on a steady path right now, would suggest that many of the bank stocks have already priced in this effect of higher NPAs that are likely to happen or likely to come into the banking system after, say, October or thereabouts.
Mandesh, Z came out with a very poor set of numbers. Question marks have been raised on the kind of accounting they followed. I mean, nothing's gone wrong in the COVID quarter so much for a media company that they had to do write-off in subscription, write-off in advertising, and also other, accounting write-offs. But the stock is holding on. I mean, with this kind of a number, the stock should have got punctured, but it is down 5-6 rupees. Why is that?
It's really surprising, actually, and much of it is also got to do with the promoter issues that it has been plagued with in the past. While the promoter issues are gradually getting addressed, the core performance of the media company was never under question in the past. It's been this quarter that we have seen Z really come out with a host of accounting adjustments, which they have not done so before. But even then, one may argue that while the core performance of a company like Z would, from a forward-looking perspective, remain unaltered, one has to really take a pause on and look at whether the valuations justify what the core outlook will be. Right now, I would say the risk-reward is favoring a Z, given the sharp fall in the stock. Normally speaking, a fall in the stock also enhances the risk-reward ratio. So that is what is really happening right now.
Okay, that's the word coming in on Z, and of course Kotak is a stock that we are tracking. For the market though, we're about 0.5% lower. 1120 is where we're currently at for the Nifty futures. The breadth of course has been weak from the word go. Excuse me. ICICI Bank, that's one stock that I just want to bring up for you on your screens. That's down at the lows of the day. It's a 6% cut that we're seeing on ICICI Bank. It was closer to 400 just last week. And after its earnings, most of that price action has gotten undone, just about defending 360 now on the Nifty futures. Kunal, a word on ICICI Bank and the kind of weakness that you're seeing on the stock after its earnings.
Yeah, I think it's surprised most of the guys, because I think post the earnings, everyone was expecting that ICICI Bank could probably come back to those 390, 395 levels which it tested, I think on Thursday or Wednesday, if I'm not wrong. So there was some sort of a positive expectation. In fact, even on the data front, it was completely opposite of how the Axis Bank positioning happened. So I remember clearly that we were discussing that how Axis Bank, there were many shorts which were built up. For ICICI Bank, it was completely contrary. There were many longs which were built up. So the puts of 370 strike, 380 strike as well were the ones which were written up into, and generally when you write when traders write put options, the expectation is that the stock would not fall below those kind of levels, and there would be some expectation of a bounce back happening into those names. But again, I think the markets are now trying to surprise many of the short-term traders, especially on the results front. Where there are weaker set of numbers, the stock generally goes through a bounce back, and when there are some stronger set of numbers, the stock generally goes through a corrective phase. So I think in that regards, maybe ICICI Bank is going through a bit of a contrarian or a reversal trade over here. I still believe that 340, 360, 350 zone is a very important support zone for ICICI Bank. Maybe the stock can test that level over the next couple of days. But I think at those levels, traders should look at maybe for a contra buy behavior, because then ICICI Bank as well as the Bank Nifty overall could get back into an extremely oversold territory, which again attracts a very good risk reward to enter fresh longs.
Technology, though, that's really one pillar which is holding on in today's trading session. So, be it HCL Technologies, which is up 3.25%, TCS, Infosys, TechM, they're all names which are actually holding out. So, sectorally, you'd have to say this is that one trend which is actually looking good. Add to that cement as well. UltraTech Cement holding out. You've got Ambuja as well, which is looking very strong. So, both these names are giving you traction of about 3 to 3.5% apiece. And besides that, there's Asian Paints as well, which after its earnings just last week has managed to really hold strong. Another 3.5% bump up is what you're seeing on Asian Paints as well. Mahantesh, any ancillary trends to the economic activity picking up, be it paints, be it cement, that you think are investment worthy?
So discretionary spends is what is going to rise up, or there will be an upgrade that will happen in the way people will start spending, and therefore consumer discretionary is the space to watch out for. We already know that the rural economy, thanks to buoyant agricultural activity, is doing really well, and that helps up drive demand for consumer durables. And hence we would be looking at the discretionary space. So within the discretionary space, consumer discretionary space, the spectrum is large. It starts from something like automobiles to home appliances to even such thing as apparel and clothing. Now, in this respect, I would reckon that the automobile space, particularly the two-wheeler space, will do better. Home appliances will continue to do well, and we will potentially see pent-up demand in such things as, let's say, room air conditioners to TV sets to host of other appliances that is likely to have. Come the festival season, we will see discretionary spends going up. Consumer durables, therefore, would be the ones to watch out for.
All right. In fact, let's listen in to the management of Asian Paints. The numbers still better than what was expected this time around. We actually spoke to Amit Singal. Hear him out.
Okay, great. Because of the lockdown, we have been practically closed from 20th of March to about the end of April. So the entire month of April was an absolute washout as we see it, and we really opened up only in the month of May. So what we saw in the month of May was definitely a lot of pent-up demand because the markets were closed for so much time and people had to kind of really look at some of those real pent-up maintenance issues which had come up. And therefore, I would say that the month of May largely went in terms of really satisfying the pent-up demand across the country. However, I think the good part was that in the month of June, triggered by our Safe Painting campaign, which really kind of gave the people confidence that you can get a set of painters into your house and it is safe to kind of do and get into painting. We saw a lot of secondary demand come up across the cities and that has boosted our confidence that it was not only the pent-up demand which was kind of there in May, but a lot of new demand which came in both in the area of painting, waterproofing, and so on and so forth, led also by another campaign which we did, which was terrace waterproofing. So we feel that a lot of demand which has come in the month of June is definitely new paint demand, which is kind of boosting our confidence in terms of, how possibly we are looking at the market at the moment.
Okay, so that's on Asian Paints. Let's just take a look at what else is in focus this afternoon. I mean, we touched upon some of the move that we're seeing on a couple of those earnings reactions as well as IT names. But overall, the trend is definitely weaker today. Mahantesh, let's get your take on some of the IT names then. It's not just the frontliners, but also the mid-cap names that have definitely been standing out of late. What kind of preference or weightage would you really give some of these IT counters at this point of time?
If you recall, when the COVID phenomenon began in March, we were the ones who were saying that IT company or IT sector as a whole will continue to do well. And that particular prediction is somehow coming true. And that's simply because IT companies are first and foremost, they're accustomed to the work from home kind of environment. Number two, there is an unabated kind of activity happening on the deal side. Many of the IT companies constantly work towards engaging more and more clients, both horizontally as well as vertically, and therefore large deal wins are coming to the kitty of most of the IT companies. That is what is driving up many of the IT companies, apart from the defensive strategies that most people would have applied by pushing their portfolio into the IT stocks. So right now, I would say that the outlook for IT companies is strengthening because there is a lot of background work on deal activity that has happened and which will come to the surface once we get more in farther into the fiscal year. And most of the IT companies have also demonstrated that they are able to up their margins in this period of lockdown. So a healthy set of financial numbers are getting posted. I wouldn't be surprised if IT companies further get re-rated upwards.
All right, in conversation with CK Narayan and we've got Mahantesh Sabarad, but the stock which I want to flag off is actually MCX and Bombay Stock Exchange. Exchanges are today on a tear. Exchanges are essentially like modern platforms, a point what Hiren was making, and some of these exchanges surely have a long way to go, given that the trading volumes globally by Robinhood traders and in India by work-at-home traders has actually just intensified. Mahantesh, I refuse to buy the argument when everybody is saying that just because retail investors are back or retail traders are there and volumes are going higher, it's time to really blow the trumpet and it's time to get out. Sometimes I wonder that why do we always look down at retail investors, and when retail investors or retail traders are always buying, that is sign of a market peak. I mean, retail guys bought gold a couple of years ago. Gold has given great returns. They avoided equity a couple of years ago, and equity has not given great returns in 3-4 years.
So, what is the question, Nikunj?
My question, Mahantesh, is that every large institutional investor who comes on our channel and various forums is always flagging off the fact that retail investors are there, we should avoid the market. There is momentum and there is this FOMO effect which has kicked in. Would you buy this argument? Historically, we've always used the retail activity as a benchmark of what not to do, rather what to do. Now the retail activity is back. How should one read into it?
So in a way, the market's perception about retail investors actually entering the market and taking it higher to a level where it's right time to sell has been simply because retail investors have largely been interested in small cap names and mid cap names in the equities. But that is not the case in the current environment where you have these Robinhood investors. The Robinhood investors are taking equal interest in even large cap names and investing in the broader set of stocks, and therefore this effect or this perception about retail investors being taking the market to a level which is unsustainably high, it doesn't hold true any longer, at least in this environment. They are not into large cap, mid cap stocks. They're not into small cap, mid cap stocks. They're into the large cap stocks. And therefore, I would reckon that today, most of these retail investors are becoming a lot more savvier. They have a large amount of research advice backing them up. That research advice is coming in through a lot of platform kind of guys that you just talked about. And so research is available, tailor-made, available at your fingertips, and good quality research is available even to the retail investors. No longer it is the case that institutional investors would have quality research behind them, backing their ideas, backing their stock buys. Retail investors also have quality advice. And I would reckon that this phenomenon of the market going up with higher retail participation will continue for some more time, because they are also getting invested into the large cap names. So yes, to some extent, I agree with what you're trying to say, that it's the bad picture that gets painted when retail investors enter the market is no longer true.